Hello, and welcome to our channel Pursuit of Wealth. This channel is your ultimate destination for learning about finance and wealth, investing in crypto, informational and educational trends in finance management. If you are someone who wishes to become wealthy and looking for smart money management options, then we are fortunate to have found each other. Investing can be intimidating when you have to choose from many different options. And because of this, it is hard to figure out which type of investment is suitable for your portfolio. By knowing the different types of investments, you can achieve your financial goal. Every investment type has its own general set of features, risks, and ways in which they can be used by investors. So, it is essential to weigh types of investments carefully. Well, in today's video, we are going to tell you about 8 different types of investments. It'll be a quick guide that will walk you through different types of investments available to an investor. Mutual funds. A mutual fund is a collection of funds through many investment firms immersed widely in various businesses. Mutual funds can be handled directly or indirectly. The new investment must have an investment handler who chooses the right path to invest the investor's money. Investment managers frequently attempt to overperform specific industry indicators by supporting strategies that improve the index. Passive investing, also widely recognized as passively managed financing, records a significant stock market index. Index mutual funds can put the money in a diverse range of securities, including stocks, debt instruments, commodity markets, currency markets, and derivative products. Index funds convey some of the same kind of consequences as equities and bond funds, which vary based on where they're deeply involved. However, the threat is mostly lower since funds are intrinsically hedged. Mutual funds enable us to buy a wide variety of assets in one transaction. These monies pool funds from a wide range of investors and then hire a professional administrator to put cash in shares, bond funds, or many other holdings. Mutual funds adhere to a predetermined strategic plan. A fund may invest inside particular shares or bonds, such as foreign stocks or corporate bonds. Some mutual funds hold both bonds and stocks. The mutual fund's vulnerability level is determined by the investments it has. Gold. Countries have held gold for a myriad of purposes over the millennia. Communities and now financial systems have assigned monetary significance to gold, thereby entrenching its importance. When those specific types of currency fail, it is the material we turn to, so it will always have particular significance as liability coverage against rough patches. Investors can invest in gold and other commodity markets like platinum or petroleum products. The exercise of making a capital outlay in gold dates back centuries, but this does not inevitably imply that it is a wise purchase. Because gold is a natural resource, its value is set by scarcity and dread, influenced by political conventions or ecological factors. If you're thinking about gold investment, keep in mind that your perimeter fence, defense versus a price reduction, is influenced by exterior considerations, which means the valuation can swing a bunch wildly and instantaneously. Once shortfall and dread are plentiful, the value of gold generally increases, as well as when gold is commonly accessible, the cost usually falls. Bonds. If you purchase a bond, you primarily finance cash to a corporation. In most cases, this is a company or a federal agency. Corporate bonds are issued by corporations, whereas local authorities issue municipal bonds. The United States Reserve Bank issues treasury bonds, annotations, and debts, which seem to be debt securities that investors can buy. Bonds can be improved for a specific time frame, throughout which the bondholder gains interest costs. The percentage of such payouts is determined by the interest income set by the bond's issuing company when the bond is approved. It is known as a coupon rate, and it could indeed be patched or changeable. The bond creditor is obligated to settle the bond's average or principal amount somewhere at the final moment of the specified time frame, closing date. Bonds are presumed to be relatively more secure assets than stocks since they typically offer a consistent stream of earnings. However, as they're more secure, their protracted repayment will most likely be lower in comparison to stocks. On the other hand, bonds could sometimes surpass the rate of interest in a specific store. bonds are susceptible to a range of investment risks, along with credit risk, redemption risk, and risk in interest rates. Stocks. Stocks, also recognized as shareholdings or equity markets, are possibly the very best and most straightforward way to invest. Once you purchase shares, you buy a shareholding in a publicly listed corporation. Firms offload raised capital funds for new ventures or expansion. So, if you make investments, you are purchasing a portion of a business's property. You are indeed a stockholder. A stock is a type of investment in a particular corporation. Once you acquire a store, you are purchasing a share or even a tiny proportion of the firm's resources and revenues. Organizations sell stock in their businesses to obtain funds. Shareholders could then trade their shares with each other. Stocks can produce high returns, but they also carry a higher risk than all the different investment opportunities. Companies' values can fall, or they might get out of the venture. Stocks are classified into two categories. Common stocks. Shareholders possess a portion of the corporation, get the ability to cast a ballot on concerns regarding the industry, and might even be paid off handsomely. Preferred stocks. It is a type of shareholding that can have whatever subset of characteristics that common stock does not have, such as the characteristics of both an ownership and a debenture, and is thus regarded as a blended intervention. The dividend payments and threats for both categories of stocks differ accordingly, namely the economic system, political climate, performance outcomes, and various stock market dimensions. Cryptocurrencies. Cryptocurrencies are indeed a relatively modern way to invest. They are ungoverned tokens that can be traded on a crypto exchange. Digital currencies, like Bitcoin and cryptos, had already sparked a great deal of attention like an asset client in the past few years, owing to the rapid and sensational expansion. Indeed, they continue to stay a hazardous opportunity to invest due to the numerous unidentified contributing factors. There is still a significant chance of state regulation and the prospect that virtual currency would never be widely accepted as a means of payment. Cryptocurrency presently has no real value and might vanish as rapidly as it appeared. Users can swap US dollars for digital currencies in the same way you would exchange United States dollars with a specific monetary system, like euros, dollars, or rubles. However, digital currencies are still a jest of forex trading. The technicians of investing in them are highly parallel. Numerous crypto buyers believe that now the worth of such digital currencies rises even against the US dollars, although they are comparatively easy to acquire electronically. Exchange-traded funds. ETFs are index funds that detect a benchmark index and attempt to replicate its efficiency. Such as index funds are less expensive than direct or mutual funds since they're not managed efficiently. The primary distinction between index funds and exchange-traded funds, or ETF, is how these were acquired. ETFs barter on an interaction like stocks, which implies you can resell ETFs at any time, as well as the cost of an ETF could well vary across the day. Index and equity funds across that particular side are only marked up once each barter day. VAT wages stay constant regardless of when you acquire it or sell it. Even though ETFs are bought and sold on the stock exchange, investors have more pricing power to buy them and will pay lesser surcharges. Your remuneration relies entirely on how effectively or inadequately the score in which you buy shares continues to perform. Putting money in an ETF that detects a wide-ranging index could help you lower your potential losses. Apart from investing in corporate entities, an ETF is undoubtedly a better choice for new investors. Real estate investments. The real estate industry keeps the enormous potential for various sectors, including hotels, general merchandise, commercial shelter, production, and many others. Investors can achieve considerable capital appreciation by commercial investment or rental homes, as well as active mutual finances. When buying in the actual state, the time frame is almost everything. Real estate holdings could be extremely undercapitalized, which means that it must be tough to sell the assets rapidly in the circumstance of an immediate financial necessity. There seem to be many forms of investments in real estate. Still, the majority breaks down into two subgroups. Physical real estate holdings, such as land, residential, and commercial properties, as well as other modes of investing that do not require physical property ownership, such as REITs and online crowdfunding, are types of physical real estate holdings. Residential real estate includes almost any workplace where employees reside or linger, including detached homes, rental units, and cottages. Residential real estate owners hold revenue by charging lease or service charges for relatively short leases from tenancies, or by the appreciation in the market value of the property in between the time people buy this and the time they sell it. Commodities. Commodity funds invest in commodity markets, which are raw resources or essential goods. These schemes invest in metals like gold and platinum, energy supplies like petroleum, and agriculture commodities like grain. Commodity funds can also participate in the businesses that manufacture these goods. Commodities traded on exchanges must meet stringent quality requirements. Items are subjected to strict assessment and investigation methodologies at sales. Commodity funds have traditionally given investors diversity, risk insurance, and upside possibilities. Like any other sort of investment, commodity funds contain risks and may not even be suitable for all portfolios. Commodities can be incredibly volatile, exposing traders to significant price fluctuations. Governmental, economical, foreign capital, and exploratory risk are all factors that affect entities and commodity firms. These are the 8 different types of investments that you can invest in. Every investment type offers a varying level of risk-to-reward ratio, although risk and return on investments should not be the only consideration of an investor. Every investor should also consider factors such as its asset allocation, fees, history, liquidity, etc. So, your investment plan must ensure that your portfolio aligns with risk tolerance, goals, and period. That's it for the video. Please subscribe to the channel, like the video, and press the bell icon for more amazing content about wealth management and finance-related videos. Success is coming your way. Keep your doors open. See ya till the next time.